we're going to have a second consecutive quarter of negative real GDP growth, which means we're literally in a recession. As defined by the NBER, that's technical definition of a recession, 2 quarters in a row of negative real GDP growth. Now, the real question, David, is this a prolonged recession? How bad is this recession? And what are the effects on your portfolio and the economy? Now, Goldman Sachs put out a table last, I think, week that shows that the average or the median recession over the last 50 years has lasted 4 quarters and has seen earnings drop by 14% on average. And now analysts out there are expecting earnings in the S&P 500 to grow by 9% this year. So there is this cognitive dissonance. I think it's very important. People are not prepared for what's coming, I believe.
A recession is almost a near certainty now, according to Alfonso Peccatiello, author of The Macro Compass. People are just not prepared for what's coming next, he said in an interview with Kitco News. The outlook for the global economy has darkened significantly in recent months. The head of the IMF has warned, and the world faces an increasing risk of recession in the next 12 months. Economists and investors now think the U.S. Federal Reserve could hike interest rates by a historic 1% when its board meets in 2 weeks' time. The Bank of Canada shocked markets on Wednesday by raising its base rate by a full percentage point, while the Reserve Bank of New Zealand increased its benchmark rate by 0.5% this week, as did the Bank of Korea. Singapore's central bank also tightened its monetary policy on Thursday. Along with another expected move higher by the Fed, this keeps heaping pressure on other central banks to follow suit to bring inflation under control. The odds of the U.S. economy falling into recession by next year are greater than 50%, TD Securities said Monday. Outlining 3 potential risks, the investment bank named rising gas prices, a hawkish Federal Reserve, and a generally slowing economy. But listen Alfonso give his analysis.
So what's coming is that if I look at any of my forward-looking indicators out there, I have a bunch of them. So let's talk about the credit impulse, for example.
Yes, let's talk about that one.
So the credit impulse is a series I develop. It tracks the amount of spendable money that we get on our bank accounts, we as citizens, corporate citizens, households, and it tracks whether this amount of money is increasing or decreasing across the 5 largest economies. And why is it relevant? Because the more money we get on our bank accounts, the more likely we are to spend some of those and to foster economic activity. So when this credit impulse goes up, if you give it a lag of like 6 to 9 months, then also economic activity will pick up. When the pace of creation of this credit slows down, then also economic activity slows down. You can see that in that chart. The global credit impulse went through the roof in the first quarter of 2021 because governments were sending us checks. They were cutting taxes. They were making sure we had more available money at our disposal. Well, fast forward 9 months later, in 2021, earnings to the roof, GDP to the roof. Now you go to 2022 and credit is drying up. The government isn't sending us checks anymore. Corporates are struggling to borrow because credit conditions have tightened so aggressively. Mortgage rates have gone through the roof. So if you want credit to buy a house, it's much more complicated today than it was a year ago. So credit impulse drops. And what happens is that normally earnings will also drop with a 12 months lag, which is between 2022 and 2023. And the scale of this drop seems to be very, very large. Mm-hmm. And I don't think analysts are pricing that in. Also, if you look at any other survey, forward-looking indicator survey, like the NFIB survey, the Philly Fed survey, some of these prints, when CEOs or small companies are interviewed, David, they're asked, what is your outlook for the next 6 to 12 months when it comes to sales, when it comes to the volume of your sales you're going to be doing, your business outlook? The answer they just gave is the worst on record. It's the worst since the 80s. It's worse than the recessions we've had in the 80s. It's worse than the dot-com bubble. It's worse than the great financial crisis answers on average. So how can people expect only a mild recession, if anything? How can analysts expect a 9% earnings growth this year? Yeah. So what basically this chart shows is that by April 2021, David, everybody was as optimistic as they could ever be about the outlook for business conditions 12 months forward. Mm-hmm. So in April 2021, you had a lot of stimulus checks still growing through the economy. You had vaccinations, you had reopenings. Everybody was as optimistic as it can be. And hey, guess what? 8 months later, we had the real GDP in America recording for 2021 plus 5.7% real GDP growth. That was very strong. Now, after April 2021, what happened is that the economy kept growing, but the pace of growth actually slowed down. So you weren't, of course, in a recession in 2021, not nearly, but you were growing at a decelerating pace. And that's what the small business outlook for general business condition is showing you on that chart. You start dropping your confidence, your expectations that the general business conditions are going to be as great as they were in April 2021, all the way to today, where you expect them to be pretty bad over the next 12 months.
Okay. Another chart that we'd like to show the audience is the personal savings rate in the U.S. Now, that has gone down a lot since COVID. Obviously, when the pandemic first hit, we had a huge spike in personal savings rate because nobody could spend any money. Now, there's two ways to interpret this data. It's now come down to way below pandemic levels. One could say that, no one has any money left to spend on anything, which is bad for a lot of things, bad for the retail sector in particular. But you could also say that, well, the savings rate is low because everyone is spending their money. They're not putting their excess excess earnings into cash in their savings account. They're utilizing that into the economy, and you should see money velocity pick up. Which interpretation do you agree with more?
So my pushback to that, David, is that when I see credit card spending picking up at the pace we have seen at the beginning of 2022, while the economy is slowing down, that's always been a consistent signal of people grasping for credit to make ends meet. It's not a sustained long-term rosy spending based on the fact that the economy is going to grow and your opportunity set is going to grow when it comes to economic returns. It's mostly about making ends meet. And so if you look at credit card spending, it has gone through the roof to make sure that despite real wages actually took a hit over the last 15 months, the average salary earned by an American, a Canadian, an Italian, a German, adjusted for inflation, has actually dropped anywhere between 3 and 5%. So basically, after inflation, you're able to buy less than you were 15 months ago. Yes. When that happens for so long, the only way to bridge the gap is via credit card spending and via spending all your savings you already accumulated, plus bridging the rest with credit cards. Not a good sign as well. We're seeing now is a descent in economic growth. We're seeing a downward trend in economic growth. What you want to try and capture is that trough, is that change of sign, is once GDP has bottomed, basically has troughed, and earnings as well have been revised down all the way to -10, -15%. That's reflected in equity prices. All that pessimism is already priced in then. As well, valuations might be reduced because risk sentiment is very low. People don't want to overpay for stuff during a recession, let's be honest, guys. So at that point, you get what I call the double whammy. You get earnings revised down because GDP has really gone down. And then you get GDP troughing and you get valuations being also very depressed. The combination of earnings being hit and valuations depressed makes the equity market very cheap. That troughing point is exactly when you want to start buying equities, especially if the Federal Reserve has capitulated, has said, guys, well, we have done enough damage. Maybe inflation is slowing down too. Maybe we should accommodate. At that point, you should buy hands on first. Really, you should literally lift the equity market. But are we there yet, David? No, we are not.
Not yet.
We've got, again, analyst consensus for earnings is +9%. It is not consistent at all with the recession. And we're going to be seeing earnings coming down. That trough is nowhere close, but in a few quarters, maybe 3-4 quarters down the road, that opportunity is going to be there. We should be ready to capture that.
The odds of a recession in the next 18 months are greater than 50%, Global Head of Strategy Richard Kelly told CNBC. The World Bank has said the world is entering a protracted period of feeble growth and elevated inflation as it cut global growth forecasts by 1.2 percentage points to 2.9% for 2022. In a predicted growth of 4.1% in January, the bank added that many countries are likely to face recession. The bank blames the COVID-19 pandemic for most of the problem and said the Russian invasion of Ukraine is also a factor. The danger of stagflation is considerable today. World Bank President David Malpass wrote in the foreword to the report. Subdued growth will likely persist throughout the decade because of weak investment in most of the world. With inflation now running at multi-decade highs in many countries and supply expected to grow slowly, there is a risk that inflation will remain higher for longer. The bank thinks global growth will hover around 3% in 2023 and 2024, with inflation remaining high in many economies. Growth in the U.S., the bank said, would only be 2.5% this year, down from 5.7% last year. Europe would also see growth of 2.5% compared to 5.4% last year, the bank predicted. China was expected to grow 4.3% this year, down from 8.1% last year, the bank said. It blamed the country's draconian COVID-19 lockdowns for the slowed growth. While everyone liked to blame Russia for the inflation and economic calamities going on around the world, the truth remains that reckless spending by the government has led us to where we are today. We hope the inflation don't get as bad as feared in many quarters. Whatever happens, stay strong and savvy. Thanks for watching.